There are some blockchain minor students and hopefully also some data science minor students from the Hague University. I have the pleasure today of introducing to you Ekin Tuna. Ekin is the founder of changeslayer.io, and today's session is going to be about algorithmic trading. So Ekin has been in touch with Malva and myself for several months now. We met a few months ago. And yeah, of course, as the minor trading digital and financial assets at the Hague University, we have a big interest in automated trading. And we've been going back and forth to see if we could do a guest lecture. And that moment has arrived. So Ekin, thank you very much for taking the time out of your schedule to do this lecture with us today. I'm looking forward. Also, I'm going to be in the student position as opposed to the lecturer position right now. And this is really nice for me. And I think we're all going to learn a lot of stuff today. Super interesting topic. So Ekin, the floor is yours. Take it away.
Awesome. Thank you. So nice to meet you, everybody. I'm Ekin. Let me start by sharing screen. I have this presentation prepared. So there's something for you guys to look at the same time. So if the voice quality is bad at any point, let me know. I'll try to fix it. If you guys have any questions, also please ask them, over the call. So no need to wait for until the end. Easier to go over the topics if there's something as we go along. But yeah, awesome. Very excited to be here. So thanks guys for having me. Yeah, so let's get started. Yeah, my name is Ekin Tuna. So I'll just give you a bit of an overview of who I am and what I'm doing. So and how I kind of ended up here. To start with, so. So basically, yeah, I've been in the space for a few years now. Kind of started off as a hobby, side hustle, then slowly moved into full time, and kind of my main thing has been to build projects and companies. So those kind of decentralized projects and coins listed on the CoinMarketCap. I've been working with some of those from the early days. And also up until quite a recent future, the way that I kind of approached the investment space was more in terms of a manual trading investment. And I've kind of over time come to realize that basically that's not the right approach, as at least for me, because manual trading for me, it causes panic. It's FOMO. You're waiting there with your margin long with 10x leverage, and it doesn't make sense, right? In that way. So as a kind of a person who's more into data science and computer science and all that stuff, I started looking into the automated trading. So making things systematic, making them automized, because yeah, I kind of figured out that investing is easy, but trading is very difficult, and I'm sure all of you guys here know it as well, at least the people in the trading minor. So that's kind of how the background of me kind of coming here. So what I do now is I'm one of the founders at changeslayer.io, and our mission is to help traders become better. So roughly this means that moving manual traders into more towards the quant space, helping people to get access to tools and APIs to automate their trading and to really understand the markets better. Because one thing that we've discovered when we started the company is that basically some of the tools and data were super expensive. So there's no easy way for people to access a quality data, quality tool without investing. When you're a hedge fund, you can pay, 5,000 a month for having a data connection, but you cannot do it while you're, an individual trader. So that's the kind of gap we wanna bridge here. So if you think about TradingView, that TradingView scripting, the TradingView automation, taking that to the next level of actually building proper algos with the similar type of data while having the same flexibility. So that's on the product side, what we do. And then on the other side, we have a community of traders. So we have a lot of brilliant people in our community who are algo traders. So that's in the Discord. And for that, we do, this type of events. So we do webinars. And we try to produce content that's educational for traders, especially who want to kind of move their game into the quantitative side. Weekly calls, support sessions, and all this kind of stuff on the side of building the actual APIs and products. So yeah, the topic today, it would be talking about algo trading. So just a quote unquote here, which is kind of boring, but it's mainly to allow traders to establish specific rules for entries and exits that can automatically be executed with computers. Very, very nutshell type of definition there. But basically 70-80% of trading nowadays is automated. And honestly, I think that number is pretty, I don't know if it's accurate, because even if you do a manual execution and you route it through a broker, that broker has a algorithm to actually divide it and do the, how do you say, post-processing of the order in an automated way. So that number, depending on how you look at it, fully automated, yeah, that's probably 70-80%, but most trading involves a lot of automation, like aside of that. And that's on the US stock exchanges. I don't have numbers on crypto because that's the area that we're focusing a bit more. But that would be, I would imagine, an estimate that it's at least that much, probably more, especially when you consider all the type of ridiculous amounts of volumes that are out there on different platforms. So when we think about algo trading, so that's kind of a set of rules that automatically executes and sees what the results were of those executions and then documents it. So something that can be further analyzed. There's a few benefits when you think about algo trading and automating partially at least what you're doing. So if you think about having a manual strategy, whatever that strategy is that you're working on, we know that there's hundreds of thousands of markets literally in the world. In crypto already there's I think more than 100,000 easily. There's so many markets to keep track of. So how do you actually do that? Like if your strategy works on like Bitcoin dollar pair and you have 100 markets, technically you would have to monitor all of them if you're working on a strategy that's on an exchange level, and that's a lot, right? So how do you create, automating and algo trading allows you to basically keep track of this stuff by having automated signal creation, so that you're always going to know what's going on and know the prices when they hit the right place. Yeah, then the order execution itself. So if you base your trades, so the idea is that there's a signal. So, your strategy says that if let's say price of Bitcoin is 50,000, you put a big short on, for example. So if your strategy works so that it automatically alerts you when the price is 50,000, then you can immediately place the order as well. So it means that your order and the execution of the order can be instant and it can be accurate. So you're still going to have that full control over it, but you're always going to be able to do it at the moment when it should be done. And it's not like, the price hit 50,000, you looked at your phone and it was already 50,500 at that point. So there could be a thing that that you missed basically because just of the delay of looking things manually. Also, if you have an automated strategy, it always follows it. So if you made the strategy good, then it's going to follow it and you're going to make profit and it's going to be good. But if you didn't do it properly, then you're going to be making losses because it's always going to follow that, right? So that can backfire too. So I don't know if you guys are familiar with flash crashes, but I think this is an awesome example because basically the high frequency traders, this was mainly New York Stock Exchange, Nasdaq, and Wall Street. So I think what happened there, as far as I know, with at least in the 2010 crash, was that a guy realized that basically if you put quickly a very large order into the order book, the market makers are going to be starting to buy the smaller orders below it in order that they can sell those orders back to the bigger one with a profit. So that's kind of a front-running strategy. So the idea is that they see somebody's going to buy a big order. They buy the ones that they would hit normally, moving the price a bit and selling them back to that guy in a profit, or I mean, not gender neutrally in this case. So what happened was that he flashed a $4.2 billion trade. I can't remember which stock it was, but it effectively meant that because of the entire process of trading was automated, it dumped the entire market. So within, let's say, I can't remember exactly, but within 10 minutes, they had to shut down the market because it was crashing to the extent that it was a catastrophic event. So the strategy always follows. Market can change, but strategy will always remain the same to the benefit of your profits or to the loss of them. And then another point is that some strategies are just too complex to actually execute manually. So when you're looking at indicators, you have moving averages, you have RSIs, MACDs, and then you try to find ratios between all of those. And put them at the same time in one data point to find out when you should enter or exit. I mean, it's too much. It's when you have that much information, it becomes very difficult to handle all of it, to do it manually across multiple markets. So basically, because of all of this complexity, the automation just makes complete sense. And there's people who I know who don't, for example, automate the entire execution side, but they automate the signal creation, for example. So they've built these automation systems that alert them when certain conditions are met and just send them a text message or email or whatever. So that kind of stuff is also kind of semi-automating, let's say like that. So basically, I mean, I chose to work with cryptocurrencies because been in the blockchain space for a while. But there's also a couple of legitimate reasons why it makes sense to trade cryptocurrencies versus equities or commodities or other stuff. So first of all, cryptocurrencies are volatile. They are much more volatile than normal assets. So basically it means that the more volatility there's more opportunity for making money. Because price movement effectively, if your strategy is correct, there's always going to be a price movement involved with it. And the more the price moves, the more there's going to be, just on a very, clean cut way, let's say, the volatility will usually imply the more opportunities of making money. Also, it's possible to buy fractions. So if you want to buy Bitcoin, you can buy 0.00001 Bitcoin. Whereas in some stock markets, it's more difficult to do that. And that's basically because the Bitcoin and most cryptocurrencies can be divided into 8 zeros after the comma. And then there's the one more thing, which I think it's important that everybody is aware, is that cryptocurrencies is not controlled by government, meaning that your government cannot take your money away. They cannot confiscate your bank accounts, and they cannot tell that, hey, today we're going to be printing 1 trillion euros more. And you know what happens with that. If you've seen the Bitcoin price now, if you've seen what happens with the dollar euro rate, I mean, it means that the money that you have today, when you buy 1 carton of milk, is going to be worth half a carton of milk tomorrow. So, very basic things, but these are the things that why I've crypto is good for trading. Yeah, and talking about volatility, so here's YFI versus Tether yesterday. So in crypto, you see these kind of spikes on a weekly basis if you look at all the currencies. So this is 1 daily candle, or is it even an hourly candle? No, this is daily candle, sorry. Yeah. So this is 12,000 on price increase, right? On 1 day, which is at that point like 33% of the total value. And this is not uncommon in crypto. So the good thing is that if you're, whatever your indicator is saying, you manage to actually buy it at the right time, your upside is going to be much larger in a shorter time frame than it can be for other asset classes. I don't know if anybody is doing those decentralized protocols, but they're a good source of at least very interesting for trading at the moment, like Wi-Fi. How do you say this? Wi-Fi. Yeah, I've never actually pronounced this. Okay, so yeah, I think. Does anybody have any questions at this point? Because I'm gonna then, I think the next part will be about how we're actually gonna go about implementing automation. But if anybody has any generic questions at this point, it's maybe good to ask them now. So I'm taking there is no questions. Okay, awesome. So so how do you get started, right? So when you're looking at your normal charting software, or if you're looking at your kind of any kind of trading software or data, I mean, you need to have data, historical data, to see what the patterns were. And for algo trading, it depends on how you do it, but usually you want to get the raw data yourself. So there's a couple of ways of getting it. The most common thing is doing something called a REST request. So that's when you write a program and you ask somewhere a server or a database to return you a bunch of data. So this can be, for example, the closing prices or daily closing price of Bitcoin for 2 years. That's something that you can request program like with your code and to get it back. And then that data you can use to run your analysis on. So that's technically how you go about obtaining the data. And then once you actually have the data, you need to be sure that it is correct. So, you know, sometimes there's like stupid issues of, I don't know, there can be a zero missing. There was something that happened in the, like when whoever is storing the data, when they stored it, and they stored it incorrectly. Or a very common problem, for example, is that there is a missing data value. So you need to, like, if you're trying to analyze, let's say 2 years or 1 year or any time frame of data for any asset pair, and there's a missing value, you have to deal with it in a way that you actually create some value in it, or you let your algorithm know that might be an empty value, so you know what to do with it. So that's a very, very common problem when you do any kind of analysis. But gladly, most of the API providers and exchanges have kind of, you know, their job is to take care of these. So exchanges and our company and CCXT are pretty good sources for getting data. So I don't know to which extent people here are familiar, but CCXT is something related to algo trading when you build the system. It's a place for accessing data, let's say. So having the right data that is accurate is very important. That's where you kind of start. And then what you do after you've obtained your data, your goal is to then create a strategy that you're going to backtest. So backtesting basically means that you take your strategy, you create the conditions, and you see how would that strategy perform in the historical time period. So if you're thinking that in this 1 year, I'm gonna buy, let's say I'm gonna buy Bitcoin every time it touches or moves below, you know, 100-day moving average, that's one strategy. You just automate that and you see how it would perform. And so for this, you need to create a backtesting engine. You can do this by programming it yourself, which is fairly simple as there's a lot of open source libraries available, or you can use a existing software. And then when you kind of consider doing anything with existing software, it's important to understand that there's always limitations. So make sure that software, you understand how it works, and that also, you know, that it does have the features that are required for the type of stuff that you want to do. But you need to create an environment for the backtesting itself. Another thing that people sometimes forget to do, or you know, think it doesn't matter that much, is the transaction costs. So when you're talking about a automated strategy that you're backtesting for a year or two or so, then the transaction costs actually add up quite a lot, especially when it comes to crypto exchanges and stuff. So it can be, if every transaction costs you, you know, 0.2%, you do 10 transactions, that's already 10, that's up to 2%, right? And that's also cumulative. So every time it, the 0.2 is the same, even though the capital that you have for doing the transactions reduces. So, it will consume your money cumulatively. And then there's the kind of when you run a backtest, it's important to discuss and analyze and properly look at it. What were the kind of what happened actually in it? So one good thing is to visualize, and the other thing is good to just look at numbers. And this, by the way, might be very kind of abstract still. But basically, we're going to walk through all of this together. So you guys are going to see how this is done. And then hopefully that'll be a bit more concrete than just saying it here. But so first you get data, then you create the backtesting, right? Oh, and this is something that, for example, could be the output from a backtest. So here we had some strategy. I do not know exactly what, but can you guys, by the way, see my pointer here?
Yeah.
Okay, awesome. So we can see that this strategy, for example, these are percentages, returned 105%. So when we look at this, and we can also see it as a comparison, if you would have bought and hold this asset, you would have had 115% return. So not a very good strategy. This is actually from some of the stuff that I'll be showing later. So there's things like Sharpe ratio. So what's the basically risk reward ratio of the strategy? Sortino, which is roughly a bit different than Sharpe, but also similar in quantifying the risk versus reward of that. Drawdown is a very important quality when you evaluate your strategy. So drawdown is the concept of how much was the position in loss at the maximum. So at this point it was 20%, which is not that bad, roughly speaking. In this output we have trades. So this strategy has executed 22 trades with a 59% win rate for each trade. And the best trade returned 31% in profit. Worst trade lost 11%. You have trade durations and this kind of stuff. So this is the thing that kind of helps you on one number to summarize certain key features of the trade itself, or the strategy itself, I mean. And then you have the visualization aspect. So basically here, and I'm going to show this live in a second, but things that make sense to look at is the equity curve. So how did your initial capital develop over the time? So if you started with 1,000, where did you rise in the capital generally yourself? Profit loss. So each trade either is a profitable one or loses you money. So you want to be knowing that did this trade actually win money or lose money, and why was that? And that's some of the stuff that we're going to be looking into once we do a backtesting ourselves. But this is visually to be able to understand why a backtest performed in some way that it did. So to get started, kind of with algo trading in general, so there's a lot of well-known strategies. So Bollinger Band is one indicator that allows you to build very convenient strategies. So if you are not aware, like if you are not experienced with Bollinger Band and those strategies, it's with a quick Google, you can just you can check it out, and there's a lot of tutorials on how to implement a basic Bollinger Band strategy, which often are quite profitable. Then there's a moving average cross, and that's the one that we implemented for this specific session now. So we did a few moving average cross strategies and did a bit of optimization, which I'll show in just a second. And then once you move, you get a bit more comfortable with things. Applying statistical methods allows you to create more complex signals and more complex strategies. And then that allows you, to account for some things that you cannot for on the pure technical indicator-based stuff. And also, I mean, important part of the testing is the looking at the drawdowns, Sharpe ratios, and then there's another concept, which is the concept of a benchmark. So you have a what if scenario, right? Basically, what if I would have in the strategies that we're doing, we're going to be comparing against the buying and holding Bitcoin and Ethereum from the beginning of July until today. That's the benchmark. So that's very, I mean, in terms of the trading strategy, there is not a lot of risk because you buy and you hold. Your trading doesn't actually create any risk of the performance of your strategy. It's only the performance of Bitcoin actually, or the performance of Ethereum that creates the risk for you. So we can use that as a benchmark against the moving average strategy that we are doing. And then there's a bit of a, let's say, a footer here. So the prerequisite is usually, when you go into algo trading, is to know the basics of programming. Python is definitely the best language to start. There's a lot of tutorials on this, which I'm not going to go into. But one thing that I highly recommend is not starting with a commercial software, but start doing the programming and the implementation yourself, because then you have complete control of what it is that your program is doing, meaning that you're going to have complete understanding once you have to debug it, once you have to, really like understand where it went wrong. And some of the softwares that are out there, they remove this part, which makes it you are unaware of some very crucial but fine details that comes into when you're kind of creating any kind of software and automation. But yeah, let's not go into any more detail in that. But the question is that we did for this presentation is that if we're considering that last 6 months, so broadly speaking, since last July, Ethereum, Bitcoin has been 300% up, Ethereum has been 400% up, roughly. So is it possible to kind of create a trend following strategy that would perform better than just the pure buy and hold? So scenario one is buy Bitcoin, buy Ethereum, and hold it just until today. Or the scenario two is where you create a trading strategy, a very simple one in this case, that buys and sells it and tries to perform better than what the Bitcoin and Ethereum did themselves. So this was kind of the question to start with. So what we'll be doing is we're going to be using, so what we do actually at ChangeLayer is that we offer a free community server for people to test out their strategies. So we're going to be using a community instance to get, first of all, so we're going to go through all this process that I just talked about. So we're going to go through getting historical data for 6 months on Bitcoin USD pair and Ethereum USD pair. We're going to get it for 15 minutes, 1 hour, and 6-hour candles. What we're going to do then is we're going to create a strategy, which is the simple moving average cross strategy, and optimize it. We're going to look at the trading visualization, try to understand what went wrong, where it did well, where it went well, and yeah, run the backtest and see, did it actually perform better than the benchmark, or did it not? So that's something that kind of as a very concrete example for this we had in mind. So there's 2 variations of this strategy, but basically let's start with a simple moving average. The cross being, so we have 2 moving averages. So one moving average is the concept of if you have 5 days of data, what's the average price of those 5 days? Then if you move that average, let's say you have 1 year of data, and you always take 5 days, 5 days, 5 days, and you move it 1 day at a time. So that window moves across from the beginning of the time series all the way to the end. And we take, for this strategy, we take 2 moving averages. So one is short, so one is, let's say, 5, and the other one is long, so the other one is, let's say, 20. So the idea is that the long moving average moves shorter, the long moving average moves slower than the short one. So when the short one crosses the long one from the below, so it means that the short price is trending upwards with respect to the long moving average, then that would be a buy signal for us. And the sell signal would happen when the short moving average would be going under the long moving average. So that would be kind of a sell signal for us, meaning that roughly speaking, the price would be trending upwards or the price would be trending downwards compared to the more broad price average that's been there. So this is the idea of the strategy. And then what we're going to be doing is we're going to be optimizing this. So if we think about a strategy, it's not, you can approach it in one way, which is, okay, I'm going to take, 5 for the short moving average and 10 for the long moving average, because whatever was the approach of, let's say, somehow that was the idea. But the other idea, and this is like where you start seeing the value of algorithmic approaches, is that what if we take all the values from, let's say, 5 to 100 for the short, and in the long we could take from 20 to 200 and compare all those values against all of them, meaning that you would know for all the ranges of the values what would be the optimal approach, what would be the 2 optimal values for your strategy to perform. So that's something that we did. Actually, at this point, I'm gonna go out of this presentation and show you the code and the environment that we did this on, so you actually get a proper feeling on how this was done, because otherwise it might remain just, let's say, more like a theoretical exercise. So we can look at our community instance, which all of you are going to have access to as well. It's going to look like this and is like this. So basically, first of all, accessing data is very easy. So there's the thing called data catalog, where it's possible just to select data. So currently, ChainSlayer data is the one that we're offering everybody for free. Selecting various data types and various asset types. So for example, we could take that Bitcoin data, take it, quote it against the USDT pair. So it would be BTC USDT pair. And we could select, let's say, those hour-long candles. And we can just take it and select the data set and select add. In this case, you've selected the data set, you create it, and I'm not going to go into detail on this, but now basically we've selected the data set and we're going to be pushing it to a database. And database is somewhere, you see it's loading here. So the database is something that, when you access data anywhere in any service, it's always going to be stored in a database. So for algorithmic trading, understanding how to use this stuff is going to be, or how to access data from a database is important. And we're, again, not going to go into this, but I'm just going to show you that this is how the data looks in its raw format, basically. So it's going to be rows and columns of various values. And then what we're going to do is we're going to take a Python script and we're going to connect that Python script to the database first. And we're going to make the Python script fetch the data from the database. And after that, we're going to create the strategy. And after that, we're going to run the back testing and optimize it. And then we're going to see how it actually performed. So there's a few of these scripts here. I'm going to select the one. So actually, let's take another one for interest's sake. So let's take Ethereum and 6 hour. So we're going to be taking, in this particular case, we will take 6 hour candles. So candle means open, high, low, close data from the Binance exchange, from Ethereum USDT pair. And this data set is going to start from 1st of July. So roughly here, and we're not going to go into this code, so no worries. I'm not going to start on that, but there's a section of getting data, which is here. And it will return a object when it's asked. And then there is a part of creating a strategy. So Actually, let's do this one. This is better for this. So there's the part of getting data, and then there's a part of a strategy. So strategy creation is quite simple, but you do need to know Python. But we have short moving average, we have long moving average, and we define how these interact. So we're just basically saying if there is a crossover of the first moving average to the second moving average in a way that the first grows the second, then we're going to be buying, and in other case we're going to be selling. So this is on a very simple level what we just or this is on the code level what we just talked about. And then we're going to run the optimization. Yes, so then we're going to be running the optimizer. So for this we're going to be selecting the strategy which we just defined. And this was, by the way, I switched the data set. So this is 1 hour candles, right? So just to be clear, I just made a switch from the other script because this is actually a different one. Yeah, so basically we're doing 1 hour candles now with the strategy that we did. And we speculate that, let's say we start with 1 million as our capital. We're selecting 0.2% as the commission. So that's often what you see in crypto exchanges as well, is about 0.2%, but it can also be with 0.1 and even lower than that. So many exchanges like Binance have very nice deals where if you're coming to a referral code, you get a discount. If you hold their own token, you get a discount. So there's very reasonable ways to put this down to like 0.06 maybe or 0.07 without having to be a very big trader there in the exchange. So yeah, what we're going to be doing is we're going to be optimizing. So we're taking for the short moving average, we're taking a range between 10 and 100. And for the long moving average, we're going to be taking a range between 20 and 210. And we have to keep in mind when we're optimizing this type of strategy that the short moving average always has to be smaller than the long moving average, because if we're expecting the short moving average to bounce up and down of the long one, it's not going to be possible if they're same size or short is larger than the long one. So this is kind of a constraint that we are going to be putting into this optimization. And for this case, we basically got 3 most profitable strategies, which are, there's going to be a bit of a spoiler here, is also going to be the most profitable that we did in all of our back testings. But basically, what we're going to be seeing is that the moving average short of 10 and keeping the long at 105 was the most profitable. And here's an idea, which will perhaps make it clear on why this kind of optimization makes sense. So it's possible that so these are the possible values of what are the ranges. So the short can be anything between 10 to 110, and then the long can be anything from 20 to 210. So these were the values that we selected. So here we have the long, and here we have the short moving averages. And the more brighter yellow it is, the better the strategy performed, because we are trying to optimize this for making the most money. So whichever combination produced the most money, that's the one that we want to focus on, right? So the idea is when you build this is something called a parameter heat map. So we want to build this heat map here to understand visually, like, where does it make sense to put the strategy and where does it behave the best? Because so you see that in this corner here, this upper corner or upper right corner, like it's dark blue, meaning that it basically did no profit at all. Could be even losses, who knows? And you see that these color shadings, they move like this, almost like a weather map. So you see that the parameters that are profitable, they go and they cluster in one area. So it means that the stuff that's here, so when the long moving average is from 70 to 120, and the short moving average is from like 10 to 30, we're talking about an area that is profitable. Like that is all the parameters are vastly more profitable than on the other area. So this means that you want to understand that if you stumble upon any value, that is it an actual, like, did you just get lucky? So are all the other values completely unprofitable around it, or did you actually end up in an area where all the values around are profitable because those numbers more accurately like describe how the pair moves and allows you to predict more accurately. So this is an example then from a kind of how to look at to make your strategy better and optimize it in a way that actually makes sense. And we did this for many, well, we did 6 of these for the tutorial, and we're going to be going through them in just a second. But so basically, now we actually run the strategy for this specific thing. So we're taking 10 for the short average moving average, 105 for the long, and we can see that we actually were able to return 456% of our initial investment, which was million at this point. But changing that value will not actually in any way kind of significantly impact your results. And then here, the buy and hold. So if you would buy in this case, Ethereum in 1st of July and hold it until today, would have made you 413%. So there's about 40% better profitability, keeping in mind that we are now by the way, in giant bull markets in crypto. So, best strategy to some extent always is to buy and hold. But there's a few things that I want to actually show. Like for this particular thing, why it made sense for this strategy, and actually why this type of strategy in this case made more money than the buy and hold, because there's a reason for this, right? So in this here, we have a kind of an interactive visualization of the trades. So let's actually go through just any trade here. So we can zoom in by just, we can zoom in by scrolling, slowly. Sorry about this. This is a bit slow visualization. It's mainly on the Python library, I think. Okay, so let's take one trade here, for example. So this one. So we see here there's a trade that closed. By the way, if it's a triangle up means, sorry about that. Triangle up means that it's a long position. Triangle down means it's a short position. So long position basically is, you're entering into the trade, and the short is that you're selling it. So you're expecting the price of Ethereum in this case to go down with respect to the price of dollar in this case. So what we saw here, for example, is that in this backtesting, these green lines that, these tick lines, where these type of lines here are the trade. So this trade started here. So basically that's September 25th at 12 and closed at 30th of September at 11. That's when the trade opened and closed. And it opened here because what we programmed happened. So we have the blue moving average of 10. So you see the blue line here. And then you have the long moving average of 105. So you see the orange line here. So meaning that we see that the blue line here crossed the orange line. And that was exactly what we wanted to do. We wanted to buy when the blue line is, from under it, crossing the longer moving average, meaning that we're expecting a trend that creates profit, or we're expecting a upward trend because of that. So that's what we did. So this backtest bought it here, and then again here we see that there is again a reversal. So the smaller moving average is crossing the longer one from the above, meaning that then we expect a trend reversal. That's exactly where we sold, and this particular trade made 1.5% profits, which is, it's all right. But the main thing is with here was that, or let's take another example, which is a bit more clear, I think, because there was there was at some point, particularly here. I don't know if you guys were watching the markets, but this was basically around the end of November. There was a giant dip. So we went from Ethereum being on the top at 620 to somewhere around 480, right, at the bottom. So that's a huge dip. Like you don't, so in order for you to beat a long hold strategy, so basically the strategy where you buy at the beginning and you just hold the Ethereum, what you want to do is you have to basically try to avoid these giant dips, because this is where you lose the money, right? This is where the price which you're expecting to trending upwards is going to go down. So you want to avoid this. And the cool thing about the moving average strategy, which is the simplest strategy, it actually does this very nicely. So we saw here that we again had a buy signal, and that was at whatever 460. So we had a buy signal, meaning again the blue line crossed basically the short moving average crossed the long moving average from below, creating a signal that there would be a upward trending price, which happened, and then it rode it all the way up here to the a very significant difference in the price. And then this event happened that somebody obviously was dumping. So this is most likely somebody trying to hunt other people's long and short positions and dumps it here. So they understood that people had entered into, let's say, leverage trades, so borrowing money to have more trade capital. And then it at somewhere here, it basically dumps and creates a chain effect of the entire price going down further. But what the moving average does here, right, is that you see the peak is here, and here when the big dump starts, you see it's already trending down a bit, and then the giant drop comes, and it's going to exit the position because the short moving average is going to create a bearish signal, and that's basically why a moving average is actually moving average crossing is a powerful strategy, because it allows you don't get the top here, right? You don't get the best top, but you don't also reach the worst bottom here. So for this strategy, and this turned out to be, out of all the strategies that we backtested, the most profitable. Like, my explanation for why it was profitable is that for many of these parts, these larger drops, it was able to basically avoid getting caught in that, cut the losses there, and then create a short, enter into the long position once we're back rising. So I think for the explanation why this strategy would have performed better than just the buy and hold, that would be my my explanation for that. But in the script, and hopefully for any other backtesting thing you do on a different thing, you're going to be able to see the profit and loss of each of these trades yourself and zoom into them and really understanding what happened, why your algorithm took this trade, and most importantly, if it did some things that doesn't make sense for you, like how do you then create the new condition and rule for it so that it didn't do that, so that you're going to be able to avoid it. And yeah, then you have the top thing here was the topmost chart here is the equity curve, showing that for whatever particular strategy that you're running, like how did the equity, move from your 100% initial equity, which was $1 million at this point, and then basically how it's going to move, across your trading strategy, roughly speaking. So that's the overall one performance metric of how it performs over time. Then you got your trades, which basically will tell you how each individual trade happened, and why. And in this kind of charting context, you're going to be able to look at it visually and understand, hey, this is why it didn't perform as I wanted to, and I need to fix it. Or if it performed exactly as you wanted to, then I mean that's perfect. So overall, this is one of the backtests and optimizations that we did. But we did overall for 6 in total. So this was we did for 15 minutes, 1 hour, and 6-hour candles. Sorry, I'm going to go back to the presentation. I think, yeah.
If I can just quickly interrupt.
Yes.
Ekin, there's a question in regard to the heat map, I think.
Okay.
What happens to the graph if you have a large position in the moving tokens? I'm not entirely sure what you mean with the question, but
Wait, is it for the heat map or
I
the?
think the question was asked when you were covering the heat map, I think. So, Datselaar, could you maybe elaborate?
Yes, there is always an influence of people selling large amounts of tokens or whatever on the market. So what happens if you have a large amount? Let's say someone that did an initial coin offering dumps their 20% share. Then
Yeah.
this heat map changes, right? Because I have 20% of the network or 20% of the value. What happens to this heat map, and does that still work with this simple, this simple calculation, basically?
Yeah, that's a good question. Yeah, so actually, so the heat map here is to optimize the parameters. So I think for the heat map, it depends. So the heat map will show you, this one will show you the profitability based on if we have two indicators in our strategy. So we have short moving average and long moving average. So just for those values, what were the best parameters? So, but here's the thing: if your strategy does not account properly for that kind of situation, yeah, your profitability is gonna go out of the window. If you're gonna end up in a situation for what you just mentioned, that somebody is the founder of the team and they dump their 20% to the market, I mean, the value is going to crash. People are going to know it's whoever the founder was that dumped it. And I mean, it's kind of GG moment at that point. You're a bag holder. You will not recover from that price. So what you need to do in your strategy is to account for that. You need to have a mechanism that prevents you from getting into that situation. So, but yeah, if you don't have it, and if that happens, then this heat map is going to look very sad, most likely, because you need to have a way to account for it. But let me show you we can go back into this chart here, because so basically what we're doing here is we're selecting for the, let's go here. So this was the dump that we looked at earlier. So this strategy gave the results with the best two parameters. So we have the blue line and the orange line. So blue line being the 10 moving average, orange line being the 105 moving average. And now I'm going to go to the heat map, and we can see it here. So we had the 10 moving average, and then it was 105. So right here in between the long moving average. And in the optimization, we saw that it makes sense to actually keep this as our backtesting value, because this is the area where all the values are creating consistently more profits than, for example, anywhere in this top right half corner area. And part of it, most likely, would be because they're able to this strategy. Like we could say that this dip here would be a similar thing. It could be, well, this is Ethereum, so it could be, this is pure speculation, but somebody definitely put on a lot of shorts and dumped a lot of coins on the market, because that's the only way this price is going to move like this. So we could expect that there's some situation like that. And this strategy accounted for it by having this longer moving average here. And once the short moving average was crossing it, it immediately sold, meaning that you did not ride this whole 70% of the drawdown of what happened here, but you just cut your losses at this point, or let's say cut your profits because this was a profitable trade. But yeah, actually, when those kind of situation, what you mentioned, somebody being a founder who dumps a giant amount of tokens into the market, like in those situations, the riskiest strategy is to buy and hold, in my opinion, because basically, if you're buying and holding without having any kind of exit condition, so even if you've bought your Ethereum in this case in July and it's December and the price has doubled, let's say, and if you don't put any exit condition in when you trade, so let's say you would take a 100-day moving average and put that as the exit condition, then then you're gonna be writing it down. and that's the thing. Yeah, well, generally in the strategy, that when it comes to the heat map, it depends on how well the strategy performs, and this is just a representation of it with different values. And it's really in the strategy the key to account for this kind of black swan events. If that answers the question. So let's jump into the presentation. We're not going to look at the other scripts, but we're just gonna take it as a word that they did what we put here. So we just want to like kind of, when we think about stuff algorithmically, we want to take different kind of set of assumptions, put different kind of values and optimize for those. So we took 3 kind of values, let's say. So we took 15-minute candles, 1-hour candles, and 6-hour candles. And the assumption is that the moving average, simple moving average cross strategy would perform, one of these combinations would perform better than the actual the long and hold, right? So what we did for 15 minutes, we can see in the parameter optimization that 15 minutes performs the best from 80 to 120, and again 80 to 55 in this kind of area here. In the 1 hour, this is for Bitcoin, by the way, it performs the best here in the when there's a really long moving average and a really short moving average. 6 hours is kind of squiggled here somewhere, but you know that these are the areas where it's safe to put your kind of bets, let's say. Like here in the middle would be very safe. You cannot go very wrong because you want to look at this strategy in the future when you implement it too. Ethereum, this is what we saw this is the one we looked at, the 1 hour Ethereum. 15-minute seemed to be giving green candles everywhere. 6 hours is almost like a nice swamp map here. The point is that just by looking at it visually, it makes sense. You know that putting it somewhere here makes sense. Whereas, for example, well, this is kind of in the BTC, it's kind of in the optimized area, but it's still not as strong as here, for example. So results. Let's just look at the simple moving average. So when we evaluate the performance, so we the benchmark, right? So the benchmark is the buy and hold, buying on 1st of July, exiting at 8 of, so this was yesterday when I did the script. So this is the benchmark. So in the benchmark, Bitcoin USDT buy and hold is 335% up. Ethereum USD is 416% up. Not surprisingly, we didn't manage to beat the benchmark in Bitcoin, and we only managed to beat it with 2 on Ethereum. So, and I'm saying not surprisingly because this is a very strong bull trend, and there's not a lot of big downturns. So really, if you just buy and you ride the wave, and if that's the main trend that is now, I mean, you don't have a lot of risk there. I mean, I'm meaning you have a lot of risk, but you don't have a lot of downturns, which could have actually taken down your profitability, which is depending on the price linearly increasing. So we had those couple of situations where we looked at it, and that's where these profits basically originated from. Oh, there is no interesting pattern in this one. Yeah, okay, so yeah, so basically why this strategy works is that it's a context of the bull market as we just discussed. So yeah, starting and ending, it's a linear trend in this case almost. So it's that's why it's difficult to beat it. But we also managed to take a couple of those that actually beat it because they were able to manage the downturn. So the question for a simple moving average strategy when we're trying to beat the bull market is there's 2 things. Is the strategy able to identify price drops and short them, which we saw that it was able to do it? And another one is it able to enter back to the trend early enough? So meaning that you don't actually lose the big upswing when the price is again going up. And it seemed that it was able to do it too. So for the Ethereum part, that was okay. Bitcoin left hope for improvement. And I think we're not going to have enough time to go through all of it, but all the scripts that we had. But I'll be sharing all of that stuff so you guys can, if you want, you can try it on your own. So then we have another thing with the I tried to do a bit of a demonstration with increasing complexity, which there's going to be a spoiler, did not work. So we added some additional entry and exit conditions, but that did not work in this SMA cross, but that can be again optimized completely. So there was another series of optimizations that we did. And I will share that script too, so you guys can get a feeling of how we would enter and exit the positions. And that's maybe even like something to kind of, after you understand how the implementation and can run the code yourself, then you can move into a bit more complex order types, or let's say entry and exit conditions. So aside of just identifying the signal, then because there's also a difference in terms of if you identify a signal of the short moving average crossing the long one, when is it that you actually enter the trade? So you know that there's a signal that's come up, but then there's another part of actually entering into the trade or exiting a position. So those are other type of questions, but in such a strongly trending market as we now have, it can be a bit dangerous to have those type of complex order types that, for example, allow you to be in no position in the market, which is something that we also had. So that would be not very smart for this case. But for this other trial that we did, we ran a more advanced entry and exit conditions. We were able to produce heat maps, which showed similar things. So we'd have for 15 minutes Bitcoin, we'd have a clear area of where you want to optimize to. In 1 hour, we'd have also on the right side here, so towards the more larger values in the long moving average. In the 6 hour, very strange things happening. So there's not a clear cluster here at all, 1 point. But this can be a lucky shot, so this would not be, like if you look at this kind of a heat map, this would be a bit dangerous because there's not a lot of green values around it. And there's no clear trend that this is an area where you should want to optimize towards. For Ethereum, well, these were the heat maps that we did with the more complex conditions of entering and exiting. But here's the point that I wanted to make. So what we actually found out here is that it was a bad idea. The simple moving average was able to beat Ethereum, not very much, but clearly beat it. But the complex conditions in the bull market that we just observed didn't make a lot of sense. It could be that the same strategy would work better when it's not a strong bull signal or bull market as it is now. So when it's, let's say, a ranging market that moves between a range and doesn't really go up or down trending, for example, then there's a different strategy that could work better. Yeah, that's basically the conclusion. So what I guess I wanted to kind of just quickly mention this because it's important to keep your strategies as simple as possible. So having 10 indicators, or I don't know, 3, 4, 5 indicators, having complex entry exit conditions will make things more difficult. So it's also more difficult to I mean, complexity just makes it more difficult to predict how it's going to work and also to understand it. Just to manage your strategy, the simpler it is, the easier it will be always to manage, especially when you go with automated stuff. You do want to keep things in a way that you can actually understand why the bot traded as it did, as a general rule. And they are often also more profitable, as we saw, the simpler strategy. And then just in a kind of in a more generic point of view, what is the point of algo trading? Like if you look at like larger data sets, you look at values, like what's the point of that? So the point for you is to identify patterns in data. So you see a data set that is crossing over time. So we just saw the data set that crossed over 6 months. We took a couple of parameters and we tried to optimize. And with the optimization, we already saw that there was a large difference. I mean, there's really a clear large differences in the profitability. So it's not a large thing. The strategy is the same, but the optimization of the values of all the parameters make the world of a difference, because we can see that. So here, for example, this is the same period of time, but just different granularity of data. So 15 minute, 1 hour, 6 hour. And we can see a very big difference of 100% between these two data types. Even the time frame is the same. And also the optimization. So we could also here, if we would run the same strategy with any values here, it would be barely profitable. This would be making losses in these deep blue areas, most likely. So really the optimization makes a very big difference into the performance of the strategy. And that's also where you get the edge. Like if you trade manually and you look at the parameters that you select, there's a whole world of values that you are missing and combinations that could work much better with the strategy that you have in mind. So that's why like the strategy is geared towards understanding how the patterns in the data behave. So what is the general logic? And then the algo part is actually to optimize it properly. You want to optimize it so that the patterns that you predict are going to happen are going to be matching most of the time. And then the profit comes in once you have the ability to identify the patterns more consistently. Then you're going to be able to make the profit, because then your algorithm is consistently identifying the similar type of conditions working. This is, by the way, not to say that you don't need to optimize your algorithms, which you do. You do need to always keep in mind of optimizing. But as a mindset, this is important to understand that this is why you do it. Yeah, so then I guess we're going towards the end of time here. So we have a community of people, really brilliant traders, very good algo traders actually. So it's called Slayer Chat. It's in Discord. This is the link. I think you can take it here, or I'm sure these slides are shared maybe as well if somebody wants to take them. So please get the invite for the Slayer Chat. Join the communities there. Because we have, depending on whatever you're interested in, we have a group on trending and momentum following type of strategies. We have a group on statistical arbitrage. We have a group on machine learning, and we're setting up multiple groups this year. And also soon we're going to have trading competitions with some of the firms that we're partnering with. So we're working together with trading firms who are looking for, doing research together, looking for smart people to kind of sponsor trading competitions with. So if you want to kind of get access to that and see like how far your skills can take you in the trading world, this will be a nice opportunity to kind of, how do you say, go and enter and give it a shot. And yeah, really come by, drop by, send a message, and yeah. Yeah, this is it, guys. So if you have any questions, I think now would be a great time to ask it, because it's getting towards the end. So any questions at this point?
Yes, I have a question.
Mm-hmm.
So what you showed was kind of manual still. I had the feeling like you have to still enter what type of range you want. I was just wondering if you have used also parameters that are variable. So you have the outcome, for example, that certain strategy is very profitable, and thus you use these parameters for next trade, or just more towards machine learning, I would say. I was wondering if you use that as well.
Yeah, that makes a lot of sense. So yeah, those are well used. So there's a couple of things we're in the community doing. So it depends a bit, so what kind of strategy it is, but for regression, it's very nice to do that. So if you do regression analysis, there's these things called Kalman filters, for example, which allow you to dynamically change the values of the regression. So, but roughly speaking, it makes definitely sense to adjust the parameters over time. So when you have, let's say, our time frame would be from 1st of July until yesterday. So like you can also, aside of just, as you said, kind of looking at what's the value that works for all the range, what would be the value that would work for 1 week and then the next week and the third week and so on and so on and so on. And then you can also go into a way of predicting those values. So you could build, let's say, another type of a heat map that would optimize the parameters based on the weekly time windows as well. So you're right. I mean, definitely that makes sense. So that's definitely a good approach, and that's something that is, of course, you should do in your algorithms when you deploy them. Yeah.
Okay, thank you.
Yeah. Anybody else questions or comments also?
I have a question. According to this presentation, does it mean that the moving average is an important indicator for retail traders, because a lot of algorithms use this indicator in the algo strategy?
Yeah, that's another interesting thing. So that would be almost like trading psychology, not in the terms of managing your trade, but understanding what your opponents are doing, right? So the idea that if a lot of people are seeing that the moving averages are crossing, or there's a big, the price dipped below 50 moving average or something, that creates a signal of some sorts. So yeah, I mean, roughly, I think algorithms don't care that much, but in retail trading, people do care. So there's a lot of traders I know personally who are part of their strategies, not the main thing, but always a part of it is to understand that what would other traders be doing in retail. So if retail is generally looking at, that 100 moving average, and if that 50 moving average is crossing it, that's a big thing. And I mean, a lot of that stuff can also be seen in like the TradingView forums, like what are the popular kind of approaches. So you can kind of expect that the price will start to move in that direction. If there's a clear signal that people normally see as a, let's say, bearish signal, yeah, then you can expect that people would be more likely to start, the retail traders at least, more likely to start dumping than going long. So yeah, if that answers your question, yeah, I do think it makes a lot of sense.
Yeah, thank you.
Hello there. I also have a question.
All right.
Hi, my name is Eric van den Ham. I'm also one of the lecturers at the Hague University. So I'm a colleague of Ricardo's. Cool. And I'm teaching another minor. So that minor is called data science. And it seems like what you are telling is actually kind of a mix between the minor that Ricardo is teaching. That's all about trading and understanding how to do technical analysis and those kind of things. And the minor that I'm teaching is more about data analysis, machine learning. They learn a lot about Python and Jupyter Notebooks, all the things that, that you showed in your presentation.
Awesome.
So what my guess is that there was a group of students that kind of understand your trading story, and there's a group of students that actually understands what you were talking about when you were talking about Jupyter Notebooks, etc., and the algorithms. So from my perspective, I think it would be really great if we maybe could discuss a little bit further, maybe in another time, to see how we can come up with an assignment in which the students of both minors actually can work together, maybe to develop their own algorithm.
Awesome. Yeah, absolutely. I mean, that makes a lot of sense. Yeah, 100%. So just to kind of go into that data science side. So my general, like, I mean, we're definitely, let's say like this, our community and our interests are most in the data science trading type of stuff. So we have, for example, quite an interesting, let's say, one trader gave a very nice webinar that we recorded and published on the statistical arbitrage. So there's a concrete way to implement it, and that's something that we're doing, working on that, just as a group of people who are like-minded. So that's a really pairs trading. Statistical arbitrage is amazing. All those momentum reversals, mean reversal strategies. We have another group for, let's say, like the machine learning, like more heavy stuff there. So like heavy machine learning type of stuff. And yeah, I mean, there's a lot of assignments to do. So personally, I really like pairs trading and the idea of statistical arbitrage, which is perhaps not the best strategy at these market conditions, because strategy should always apply to the general market conditions. But roughly speaking, yeah, we have awesome groups, and if you guys want to do something together with that, I mean, yeah, would be great to do it, because I think it's a good combination to kind of take the trading logic, the hard conditions of buying and selling, and combine it with the data science. It makes a lot of sense to do that.
Okay, great. Well, thank you for that answer, and maybe we'll get back to you on this. Thanks.
Yeah, awesome. I will set up a call if that's desirable, and we can have a chat, the 3 or 4 of us, later in time.
Okay.
Awesome.
Yep.
Perfect.
Okay, cool. I think that's it. Awesome, Ekin. Very enlightening stuff. It's not often that you get a glimpse of what is actually happening in automated trading. For me, it's still relatively new, but actually the practical approach, as you've shown it today, is something that was still eluded me. So, and I think many of us with us today. So I want to thank you very much again. For doing this chat. To everyone, it's being recorded and we'll upload it to YouTube. I think on both channels, maybe will make sense. Yeah, some links have been shared. So the link to your Discord, Ekin, is also in the chat. And
Awesome.
I've also shared the links to a link to the statistical arbitrage Slayer talks. Was it Slayer talks, right? It was the format.
Yeah, it's Slayer Talks. It's the webinar series we're having. Yeah.
Yeah. Okay, so everyone who hung out, thank you very much. Ekin, thanks again. I hope we can do this again in the future. I'm sure we will. And yeah, have a great day, everyone. Thanks.
Awesome. Thank you, guys. Thank you for having me.
Cool.
Thank you.
Thank you.
Thanks.
Thank you.